I'm Charlotte McLeod with the Investing News Network, and here today with me is John Kaiser of Kaiser Research. Thanks so much for being here online with me today.
Charlotte, it's a pleasure to be on the show with you.
Thank you. So I think we should start by talking about gold, which hit a new all-time high this week. I know you've had a price target of at least $2,000 an ounce for gold for quite some time, and you reiterated that expectation to us at the beginning of the year. So now, with 2,000 clearly in sight, what do you think is the price potential for gold this year?
Well, I've been of the view that gold is set for a repricing into the $2,000 to $3,000 range. And this was last year, well before COVID-19 hit. The COVID-19 pandemic has created enormous global stresses, which are accelerating the need for gold to go into $2,000, $3,000 range. I think I wasn't really expecting it to break through until 2021, but I think we're on the threshold. It seems to be paused right now, sort of waiting, is this for real? But I think once it does, then it'll move around back and forth between $2,000, $3,000. And that's not a huge percentage gain, but it's in a context of very muted inflation, which is very, very significant for the gold juniors, for the producers, for the developers, the ones that have these ounces in the ground projects. And the reason this is happening is that this theme of rising China, rivaling the United States as right now it's the second largest economy. There's been a sea change in the way everybody viewed that. During the super cycle, we assumed that China would eventually become democratic like us. But since 2012, when Xi Jinping took power, he has put China back onto a course of hardcore autocracy with a very different agenda than the old Maoist communist one. This is one where they want to own the world commercially. They want to be able to project military power in the same degree as the United States. In the meantime, the United States, in the last 4 years, adopted a policy of let's just America against China and screw everybody else. We'll drop the Trans-Pacific Partnership, which was a sort of an attempt to contain China's power. And this has, in fact, accelerated the isolation of the United States as an entity unto itself. And the mishandling of the COVID-19 crisis, where we are now the worst country in the world in terms of cases, has the rest of the world kind of looking and saying, what is happening to this country? And the US dollar has finally started to decline against other currencies. During the panic of March, the US dollar cranked way up against all currencies because it was the safe haven. But now there's this sense that this country is losing it. The president has already said that he will not accept as valid any election outcome other than one that re-elects him, which is in a sense an anticipatory suspension of the democratic process. And it has people wondering, wow, so with interest rates now near zero and $13 trillion of sovereign bonds overseas with a negative yield, what's negative about gold that it doesn't have a yield is no longer such a big deal. So capital is now moving into gold because they don't know who is going to be the successor to the United States. We're entering an interregnum of extreme uncertainty. And later on, there'll become the panic about inflation due to printing all this money and doing fiscal stimulus. But right now, it's a rush to hedge against this extreme uncertainty. And when you consider there's only about 6 billion ounces in existence at $2,000 gold, that's $12 trillion of a hard asset that you can't quickly make more than like 90 million ounces a year, which is the current rate of production. It is very easy to conceive that there'll be not many sellers of gold and there'll be many new buyers, and it'll price itself somewhere between the $2,000 to $3,000 range over the next year.
Okay, thanks for that. I want to have you talk a little bit more about what's going on in the US, because the last time we spoke to you, I believe, was at PDAC in March. At the time, COVID-19 was a big problem for China, And you had said we need to wait and see what happens in the US, what the response will be. So now we do have a sense of that. And I wondered if you could talk about that response and how significant it's been for gold. I think the main question is COVID-19 the main factor that's moving gold right now, or are we still looking at many other underlying factors that are playing a role?
Well, the two most important leaders of the world, Xi Jinping of China and Donald Trump of the United States, both massively bungled their responses. Xi Jinping, by pretending this was not real, suppressing all the news about it, and then blaming the doctors for getting infected and not nipping this in the bud, letting it radiate across the world. And then Donald Trump, who's caught up in his impeachment proceedings, dismissing this as a scam put forth by the liberal media to try and tank the market so he looks bad for the November election, and constantly denying its reality, rejecting scientific observations, basically acting to obstruct the containment of this virus. We here in California had a significant lockdown quite early in March. I had to move from my office, which is only like 5 minutes from my home, move all my stuff back home where I've been since then. I thought I'd be able to move back, but because they never suppressed the infection rate really low, like was done in China and Europe and South Korea and all these other countries that still take science seriously, we are now ramping back up. Things are starting to lock down again, and in a couple of months we'll be in the normal flu season again, where you can expect everybody to get more cramped together and the spreading to continue. All this talk about a vaccine, who's that actually going to be available for on a timely basis? Will it actually work? That's just a mirage that they put out to get the market going. But the biggest consequence was that the rest of the world understood what was happening. And I managed to escape PDAC just in time, got home before they shut down everything. And when that market tanked, everything went down with it. But the Federal Reserve decided we are going to turn this around, because we were facing an all-out financial collapse because the virus was spreading, social distancing, shelter-in-place orders were being put out there. And they said, we will print money. And the way they print money is they go in there to buy bonds. So they take the bonds off people's hands, push the yields down to zero, so people are happy to sell it. But then where do they put their money? You can only have 250,000 cash in the bank, and beyond that, you're at risk of losing it if the bank goes bust. So that money flowed into the market, and we had a tremendous V-shaped recovery, and we're not that far off the high from February. But I've looked at what happened in the 1920s to the Dow, and I've normalized the trend from 2010 to the current, and it is remarkable how very closely the Dow from back then tracked the Dow from today. They both underwent a very sharp meltdown, which was stopped, and the V-shaped recovery. In fact, on a normalized basis, they're almost tracking it perfectly. But 6 months after the initial crack in 1929, it peaks and goes down relentlessly, down another 80%. That doesn't bottom until 1932. That timing coincides with the November elections. And this is where I think propping this market up, saying an economic recovery is happening, I think that's by then, that will all have failed, and we will be going back into a downtrend. And in 2008, when we had the financial crisis, gold got hammered because there was a huge hunt for liquidity at that time. But this time, what is it the government can do to prevent it from falling? It will simply fall because the earnings won't be there. The hope, if Trump had done it properly, we could be seeing a recovery in action. But now with everything stalling, and with the first $3 trillion sort of fiscal stimulus, all the unemployment payments, all these loans and that coming to an end, and with the Republicans wanting to offer only a $1 trillion extension versus $3 trillion extension, with lockdowns being imposed again as this virus resurges, we're going to have a new period of misery that makes that first period of misery, the second quarter a complete waste of time. They should have just let it all rip. And I think the unfortunate thing that's coming is they will do the herd immunity thing and just say, tough luck if you're old and sick. Most people, they get it and survive. A few have, longer lasting or lifelong lasting consequences, but you're just going to have to tough it out. And it's in line with this sort of attitude of you're either a winner or a loser that the president pretty much projects to the public. So when this starts happening, I'm not sure that the market, that the general equity market will be able to sustain the valuations that it has currently.
Okay, and what would you expect to see from the Federal Reserve in that kind of situation? We actually have a statement coming later today. It's July 29th from the Fed. What tools have they been using, and will they be able to continue using them if we continue on to this type of situation that you're foreseeing?
They will continue to expand the balance sheet, to push money into the system, to take bonds out of it, and to push that money further into these equities. Except this is what's really good for gold, because people are going to look, these stocks are all overpriced. This stupid virus is not going away. In fact, it's getting worse. Maybe I will go into gold and park it there for a while. And even Goldman Sachs is now predicting $2,300 gold. Goldman Sachs, $2,300 gold? Oh, that's insane. So people will start to listen to that, and that will have a very substantial trickle-down effect in the whole sort of junior and senior producer sector. I created an index of the 52 primary gold producers out there in the Canadian and Australian and US exchanges, and it's up only 53% from the start of the year when we hadn't yet heard of COVID or anything like that. And these all stand to benefit extraordinarily from gold marching into this $2,000 to $3,000 range, because the inflationary pressures will not really manifest themselves until, say, the middle of next year or beyond. So that narrative of hyperinflation and that, it's not going to be visible for some time. And if you have deflating asset prices, like one of the topics here is that nobody wants to go downtown San Francisco and work anymore. So the whole Bay Area with its insane housing prices, do you still need to live there? So we could see a decline in real estate prices in these urban centers as people realize we're never going to be commuting to these downtown offices anymore. And of course, with equities deflating and maybe even all the FANGs starting to get their comeuppance in terms of the way they dominate the industry, start to deflate. These are things that are not really going to help boost inflation up. It's going to be more a deflationary environment. Eventually, they'll put in massive stimulus solutions to turn this around. I think we'll hopefully have COVID-19 behind us by the end of 2021, and whoever's in charge, I mean, Trump's promise at the start of his administration was infrastructure renewal. It's the one promise he hasn't made any attempt whatsoever ever to keep. And it's something the Democrats want to do. The difference as to whether it's a Trump administration in 2021 or a Democratic one is that the Democratic version of infrastructure renewal will have a green spin to it, whereas the Trump one would try to keep the old fossil fuel coal type of spin to the whole infrastructure renewal. But that will be massive expansion of debt to pay for this. But it's different from what's happening now. Right now, it's just money that's being printed and handed out to people is just going around in circle to keep the basic economy going. You have the younger people who are the hardest hit by this economic downturn for which they have no fault whatsoever. They're not lazy or anything like that. Their lives are being disrupted. There's an intergenerational war brewing between what I call post-boomers, those born after 1964, and the boomer generation of which I'm part of. And that's going to have to be resolved in a way so that the worker class that's still working, whose taxes are going to have to end up paying for it, actually get something in the future. So spending money, building infrastructure, mitigating climate change so that when the last of us boomers have ridden off into the sunset, there's still something of value for the younger people. This kind of bargain will be demanded by the younger people. And the consequences, if it isn't granted, we're talking about the United States plunging into serious civil unrest. And we're already seeing the precursors with the Black Lives Matters protests, the ongoing protests in Portland. This is a sign of things to come. And if this country does not want to mutate into a fascist dictatorship where the elites suppress everybody, they're going to have to make this sort of bargain. And that's why I think down the road, the non-gold companies, the base metal companies, the critical metal companies, they're going to flourish sooner than people expect. In fact, it isn't just gold stocks which are benefiting now. We're even seeing base metal stocks start to benefit because the market's looking ahead and saying that the only way to dig ourselves out of this hole is to create a feel-good thing of we are rebuilding our nations, we are rebuilding the world. And the only thing that worries me, is the growing conflict between China and the United States. That is hugely worrisome.
Okay, that really feeds well into one of the questions I wanted to ask, which is how are the juniors doing right now? I was going to ask specifically about gold since gold is at an all-time high. Is that action being reflected in their share prices? But we could also go beyond gold and talk about where else you see opportunity right now in this current environment.
Gold was still a dog below 1,300 last May, and then it broke through, and then we saw this phenomenon of Eric Sprott, drawing on his Kirkland Lake piggy bank and spending $200 million buying private placements in all these juniors, and I thought, wow, he's seeing that this turnaround in gold, this one's the real one, not the head fake that we had in 2016 when we thought we were coming out of our big junior bear market. But there was no thundering herd in his wake. He turned around and said, oh, it's just me. This is not so great. And in November, when I was at a conference, I was sort of saying, the junior ecosystem is dying. The regulators have made it very difficult for money to flow directly into the company, except from the hands of millionaires. They're being suffocated to death. I did have some optimism that the gold price would help. And by then, gold was already $1,600, but it wasn't really catching on in the market. There has been a very lagged response this time. After the March plunge in about June, when gold, it also went down a bit, then went up again, suddenly Bay Street woke up. And what was very different, that they weren't piling into the optionality plays, your 4 million ounces at half gram per ton that have been sitting there that sort of need $2,000 gold. They started looking at the kinds of companies that Eric Sprott was interested in, ones that had existing gold silver systems, probably not enough ounces where even a higher gold price would make them worth developing. But what was great about the juniors, that the sort of geologists' innovation, ability to rethink these systems, to harness computer technology, to visualize what's going on at depth, add new layers of data like geophysics, and sort of say, if we have money, we can drill these targets and make them bigger and better. And this is the kind of project that has attracted Bay Street. And Wallbridge, it had its little Fenelon project. These guys just wanted to mine this stuff, chase the Gabbro hosted gold, high-grade gold deeper, and then managed to find, quite by accident, this enormously high-grade system in the rocks to the west that nobody had any idea existed. And ironically, as they drilled it up closer to the surface, the grades actually sort of fizzled out. And if this had been found ages ago, it would have been said, yep, another one of these sort of failed systems in the Abitibi Greenstone Belt, that's not worth it. But Amex exploration is another classic example. The Perron project has been around for ages. Even Agnico Eagle had it for a while and couldn't really figure out what to make of it. And then they started drilling deeper. And at first the market scoffed, oh, you're just re-drilling the little high-grade thing you had. But as they drilled more and more, the system blossomed. So all of a sudden, this particular fault structure, oh, it's not this thing by itself that never really made it. It has significant potential. So this, what was a 20-cent stock is now a $3 stock with over 15 million in the treasury. So that is where an awful lot of money has gone into. I track the financing activity for the TSX venture on the monthly basis. And we're again now at a level where we were in May of 2011. And I don't know if I mentioned it already, but in terms of value traded by TSX resource listings, this week on Monday, we hit over $140 million worth. The last time we saw that much was in early May of 2011. Now, if you look a little farther back, we ain't seen anything yet in terms of what this space is capable of. So we have the juniors, the Bay Street saying, okay, even though gold's going up, we really don't want your destiny to be a function of gold, so we're kind of going to ignore that. We want you to be in control of your destiny, and we'll give you the money to drill deeper, to prove your theory, and if you start showing that it's there, we know you will need more money. There is more to come, all against this backdrop of a gold price that's rising. It's a fantastic setup because now the juniors are doing stuff. The market's happy when they're seeing better. Today, Galway Metal is one of my favorites. Even though the market's taking a bit of a breather in general, it's up 25 cents today because they put out a press release showing they hit visible gold over a very meaningful interval in a part of the property which isn't part of the known zone. So the market's saying, wow, this idea you have of building this huge new gold district in New Brunswick, it's becoming reality. So it is responding to it. And it's been a long time, at least 10 years since the market responded to what is incrementally good news as opposed to the 100-meter Fruta del Norte 12 gram per ton gold intersection. So this is a very, very exciting period for the juniors, and it is still, in my view, an awakening. And it's an awakening that isn't like focused on, say, Cisco mining and the Windfall project, these few plays which in 2016 became these power plays for Bay Street. It is expanding laterally, and that's really, really healthy sign that this bull market for the juniors has legs.
Okay, so it sounds like definitely there's money coming into the space, and there's money for not just the plays that we're seeing attention before, but an expanded number and amount of them. I wanted to ask if you have a sense of where that money is coming from. You're speaking about private placements and how it can be a little bit difficult for individual investors to make moves. So where do you see the money coming from right now, and could that change as the market continues to?
I think sort of generalist institutional investors are not yet here. Maybe they're buying the Barricks of the world, the big gold producers. But unlike in the super cycle, when institutional capital was mainly the driving force of all these companies with ounces or pounds in the ground, deposits that were failures from past exploration cycles, dragged into the money by the higher prices created by China's emergence as a major economic power, they are not here yet. I see it's family offices, high net worth individuals. Like take John Paulson. After the crash, he started this hedge fund because he'd done the big short and everybody thought he was a genius, and so he bet on gold. And it was a disaster. He ended up losing most of his fund holders, so he kind of said, screw it, I'm going to make this largely a family office. And he bet heavily in 2016 on Midas Gold. And Midas Gold, again, is an example of, it was as low as 35 cents during the March meltdown. It hit $1.50-55 in the past week. And when you rerun the numbers, as I have done, at $1,900 gold, this is a $5 to $10 stock. And it's gone up because retail has recognized it. High net worth investors are saying, okay, finally looks like there's light at the end of the tunnel with the permitting process in Idaho. This thing will end up being taken out by one of the big ones, possibly Barrick, because it already owns 10%. And retail is coming in. Now, with the cannabis phenomenon of the past few years, Robinhood, the trading platform in the United States, played a huge role with younger people using their smartphones. But through Robinhood, you only get to buy New York Stock Exchange and NASDAQ listed companies. So that crowd has yet to figure out how to discover the resource juniors. It is more retail investors who are coming back, who are familiar of the space from the 2003 to 2011 cycle. They are seeing the awakening. They're coming in. Some of the cannabis money, which can figure out how not to use Robinhood and get a brokerage firm in the United States where you can, buy these cheaper 50-cent stocks, they're starting to come in. But one of the interesting things that's happening now is the role of the influencer, of the retail person, not just as a passive victim who gets the baseball bat in the head from the insiders and the elites. They are now blossoming in all their Twitter and Facebook spaces and developing followers and covering stuff and trying to build a reputation that they know what they're talking about. This is something very healthy because the brokerage industry has become parched and shriveled, so restricted. I had one case of an analyst at a Toronto brokerage firm who came up with a crazy 35-cent target for a 20-cent stock in the nickel space. And this was supposed to be after 4 years. And he had a $1.2 billion net asset value estimate of what the project was going to be worth. And I said, how do you get 35 cents? Well, I assumed they would fund CapEx with 40% with equity at 27.5 cents, because that was a little bit higher than 20 cents. And that would result in 3.8 billion shares being issued, puffing it to 4 billion. Then you divide 1.2 billion by 4 billion. He says, why would you do that? This company's never going to fund this money. It's going to be taken out. He says, well, basically it's compliance. We're not allowed to really put out high price targets. So the brokerage industry has become largely useless in helping the public understand what is the upside potential. And this is now moving out into a broader area. My business, the newsletter business, it's kind of dead. I mean, people don't want to pay money. I've got a $275 special that gives you everything until the end of the year. Only a handful of people have taken me up on it. There's all these sort of semi-free outfits out there which are emerging as new sort of sources of information about what's happening there. And I think this will evolve. People figure out who the shills are and which ones are the real ones. So that's a big deal that's going to help this audience grow, especially when we go through $2,000 and people get to the idea that 2,000 is not the lid for this cycle. It's the base for the next 3 to 5 years, perhaps forever.
Okay, and I was going to ask you, we've been talking a lot about cycles. Where are we at in the gold cycle? It sounds like you would say just at the beginning.
I think we are in the awakening part. We had a brutal 10-year bear market that was a near-death experience for the juniors. Stocks have moved out of the below 10-cent range. They're now in the 10 to 20-cent range. The lifestyle guys and gals are all waking up and say, oh, finally a resource sector, a gold bull market, and they're changing their names back from cobalt or whatever to gold and things like that and getting geared up. But there's a lot of sort of survivors, the technically competent teams that have been shunned by the Bay Street crowds whose stories aren't quite evolved enough to attract the large money that's needed to advance them. These groups are waking up, and this is fun for me because my original story was I'm a bottom fisher. I know how to spot them and point my audience. This one is going to wake up, and the real companies, ironically, wake up slower than the fake companies. So it's not like everything has left the dock and is way out there in the bay, way too high. The next 3 to 6 months are probably the best part of that cycle. Then all the fake ones will stall. It'll be tougher for them. And then you'll start to see which ones are the ones with the stories that can go the distance, keep going and going because they have a real project that is evolving and which of course benefits from the higher metal prices.
Okay, well that's great. Do you have any final thoughts you would share with the audience before we wrap up?
One area that's sort of neglected by the market is the whole idea of security of supply, metals that are needed for new technologies. I think I've already mentioned that I think by 2021 we will see massive infrastructure spending. the metals that are into like lightweighting, niobium and scandium, rare earths, the tension between China and the United States, this isn't just something that Trump has started. The Democrats, I mean, he basically stole their protectionist platform and said, no, I'm going to take this and make this mine. So both parties are on side with this idea that China is a problem, who takes our jobs, who steals our secrets, who cheats in the overall market. So this tension is not going to go away, and China's stuck in a corner unless they get rid of their leader and say, we're going to dial back this super autocracy tangent that he has sent the country on. They're stuck ratcheting this up. And it's clear that Trump's strategy for re-election, it has two platforms. One is the law and order platform of stirring up trouble everywhere, bringing in his shock troops to arrest protesters and make everything look like a state of siege in the United States. But a more productive one is an escalation of a conflict with China. And all Americans are united that, well, we when it comes to a Chinese conflict, we're in this all together. And I have a fear that before the election, something bad is going to happen in the South Seas. And China isn't helping its cause by imposing its national security law to Hong Kong. And they're basically annexing it, which is what they're going to eventually do with Taiwan. And this is going to really, really potentially cause a risk for a military conflict. And once we have that, all these things that China ships to the rest of the world are not so easily going to get to the rest of the world. So in the background, there is a movement to think about having your rare earths, your niobium, all your metals, cobalt, come from locations which are relatively secure, but they're not really profitable right now, but we need to do something about it. And if there is a major rupture in the flow of raw materials from China, you will see these metal prices escalate. And this is in the background. We're seeing the old Mountain Pass project being taken public again. This time it's properly financed. The big difference between 2009 and 11 period when we had Rare Earth Mania 1 was China was violating the concept of globalization. Today, we are in a mode of deglobalization. And Molycorp 2, through this MP Materials, it has a completely different mandate. It's not going to be this pump and dump by the founders blowing out more stock from their private holdings than the capital they raised from the market to sustain Mountain Pass. This time is going to be different. It's going to be longer lasting. So that's a space also for investors to keep an eye on. It's different from the whole gold narrative and from the sort of macroeconomic copper nickel, and that's going to be higher. But it is something that I think is going to become very topical again.
Okay, well, thank you so much. You've given us a lot to think about. It was great to have you on. And once again, I'm Charlotte McLeod with the Invest News Network. And this is John Kaiser with Kaiser Research.
Thank you, Charlotte.
Thank you.